From last topic, we know that property is widely accepted as a good hedge against inflation, and it may improve portfolio diversification. We also know from the last topic that property generates reasonably high return with medium level of risk. However, there are certain embedded features of property that prevent many investors from investing in property. For example, high capital requirement of property investments prevents most individual investors from investing in properties, particularly commercial properties. Other obstacles such as high transaction costs and maintenance costs, illiquidity, and long investment horizons. Therefore, indirect property was introduced as a good alternative to direct investment in property and aims to address these issues of direct property investment. Indirect property can be further categorized as listed indirect property and unlisted indirect property. We'll focus on listed indirect property in this course. And in listed indirect property, we'll focus on listed real estate investment trusts, REITs. Most REITs are listed. However, there are also publicly non-listed REITs and private REITs. REITs that invest in physical properties are called equity REITs. REITs that invest in mortgages and mortgage-backed securities are called mortgage REITs. REITs that invest in a combination of physical properties, mortgages, and mortgage-backed securities are called hybrid REITs. We will focus on equity REITs. Because the vast majority of underlying assets of an equity REIT are properties, and the vast majority of income of an equity REIT is from properties, it is expected that the performance of equity REITs will closely follow the performance of property. However, for listed equity REITs, because they are listed on the stock market, factors that affect the overall stock market may also affect listed equity REITs. You will observe from the data analysis in this topic that it seems that changes in listed equity REITs lead changes in direct property market. And the current return on direct property incorporates information that has already been reflected in returns of listed equity REITs a few quarters ago. You will also observe from the data analysis that the correlation between direct property and listed equity REITs actually increase with the increase of investment horizon. These findings can be explained by the issues in the mechanism of property valuation. Because property market is such an illiquid and inefficient market, it takes a while for any new information to be incorporated into the trading price of property. However, any new information about property will be immediately incorporated into the trading price of listed equity REITs because they are traded in a very liquid and efficient market. Such a lag is called illiquidity lag. Another issue in the valuation mechanism is valuation of non-trading properties pretty much relies upon appraisal valuation. However, appraisers tend to refer to previous valuation when do the current valuation, and it may take a few rounds of valuation for the information incorporated in current property trading price to be reflected in the valuation of non-trading properties. Such a lag is called appraisal lag. Illiquidity lag and appraisal lag are the reasons why it seems that listed equity REITs lead direct property rather than the other way around. You will also observe from the data analysis that listed equity REITs track the stock market more closely than direct properties do. However, the correlation between listed equity REITs and the stock market decreases with the increase of investment horizon. It seems that although listed equity REITs are more influenced by the stock market over the short term, they are more influenced by the underlying properties in the long run. So this is the last course topic of this course. Next week will be the revision. Hope you've enjoyed the course and the videos. Good luck with your future study and future career.